Have you ever wondered what the difference is between a regular whole life insurance policy versus a whole life insurance policy designed for cash accumulation? Well, there are a few differences in the way the policy performs and their design. Today, we're going to do a deep dive on the difference between the two. Hi, I'm Olivia Kirk.
I'm Tim Urich. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
For the best advice on controlling your cash flow, be sure to subscribe to our channel. And don't forget to hit that bell to be notified when we upload new videos twice every single week. A whole life insurance policy is a permanent life insurance policy that, as long as it's enforced, it's a unilateral contract between the policy owner and the insurance company. The insurance company is going to provide all of the benefits in the contract, and the policy owner is only responsible for one thing, and that is paying the premium. The insurance company is promising to pay the death benefit once the insured dies, as long as that policy is in force, which will be the whole life as long as the premiums are paid. The second promise is to have a cash value in that policy that's equal to the face amount at the age of maturity, which is typically age 121. These policies are actuarially designed to get better and better every single year. Why? Because of that second promise. The insurance company has to stash away more and more money every single year in order to meet that second promise of having equal cash value and death benefit at that age of maturity. So we'll often get the question, hey, I'm kind of old. Can I still get a whole life insurance policy? Isn't it really expensive? And to that, the answer is, well, it is more expensive, but that's because the insurance company has less time to meet that second promise. They have to stash away more money sooner in order to meet that second promise.
So here's an example. Let's say you're 40 years old and you're thinking about insuring yourself as well as insuring your parent who is 60 years old. Now, when you're looking at insuring your parent and you're using a policy paid up at age 121, if your parent is 60 years old, there's only 61 years to stuff the premiums into so that the insurance company has cash value equal to the initial death benefit at age 121. Now, let's shift over to insuring yourself. If you're 40 years old, now you have 81 years to stuff the premiums into to make sure that the insurance company has cash value equal to the initial death benefit at your age 121. So the premiums will be lower in your situation versus your parent. But keep this in mind. For your parent's policy, the cash value will be greater everywhere along the line because the insurance company has to put more cash away because they have a shorter window in order to put that money away.
So let's shift gears. What's the difference between that regular whole life insurance policy that we just talked about versus a whole life insurance policy specially designed for cash accumulation? Typically, when you're dealing with a specially designed policy, there are a few criteria you want to have. Number one is you want to make sure the company is a non-direct recognition company that pays dividends to their policyholders. Number two, you want to make sure you have a paid up additions rider on the policy. That allows us to supercharge the cash value accumulation early on in the policy. Typically with the regular whole life insurance policy, it takes about 10 years for them to become efficient from a cash value perspective. Meaning, if you have a regular whole life insurance policy, you'll have some cash value accumulation, but it will be slow and steady up to that age 121, that age of maturity. But with a specially designed policy, the cash accumulates more quickly within the first few policy years. Typically, you could expect the first 4 policy years to be vital to have that paid up additions rider on, so you have access to a larger portion of the premiums you're paying into that policy. You see, a specially designed whole life insurance policy focuses on cash value access versus death benefit.
Now, the death benefit is also important because we're talking about a whole life policy, and usually the policy will be in effect at your death. So somebody's going to benefit from that death benefit. But the fact that the policy gets better and better year after year is the engine that makes the cash accumulation vehicle run.
Leave us a comment down below. Do you have an existing whole life insurance policy, or is it specially designed for cash accumulation? How are you using it? What are the differences that you see? Another key about these specially designed policies is it has a built-in flexibility factor. Because it has a paid up additions rider, we have the flexibility of dropping that rider and reducing the premium down to the base premium. Versus with a regular whole life insurance policy, you're kind of locked into that premium, and the only way you could get out is with a contract change to lower the face amount.
When utilizing a specially designed life insurance policy, you have the built-in flexibility to be able to reduce your premiums when life happens. Let's say the car goes, a roof, or a furnace, and cash flow is tighter, you can reduce the premium on the paid up additions rider.
Typically with these specially designed policies, you want that paid up additions rider active for anywhere between 4 and 10 years of that policy. After that, the whole life insurance policy, the base policy within the specially designed contract, becomes more and more efficient, and you no longer need that supercharger on it.
Which brings us to a question that a client had recently. And the client said, hey, if these policies get better and better every year, and by the 5th or 6th year, for every dollar I'm putting into the policy as far as base premium, my cash value is growing by more than $1, shouldn't I wait to put the paid up additions rider on in the 6th year rather than in the beginning?
And the answer to that is simple. As we went over today, the paid up additions rider is what supercharges that cash value accumulation within those first policy years. So for that reason, it's important to fund that paid up additions rider early on in the policy so that you can make your contract more efficient on a quicker basis.
Instead of the policy breaking even on an annual basis, meaning that the cash value increase is greater than the premium in like the 6th year, you could actually accelerate that to the 4th or 5th year by having a paid up additions rider on the policy right from the beginning.
One note on the similarities between these contracts, the specially designed and the regular whole life, is that both have contractual guarantees for the loan provision, meaning that if you have cash value available within your policy, you have a contractual guarantee access to that policy via the policy loan provision, so that you have flexibility and access to that money. Do you have a whole life insurance policy? Is it a regular whole life insurance policy or specially designed for cash accumulation? Are you even sure? Check out our latest YouTube video to find out the differences between these two types of whole life insurance policies and exactly how they work.
So let's review what we talked about today. First and foremost, the difference between a regular whole life insurance policy and a policy specially designed for cash accumulation. The specially designed policy has more flexibility and becomes more efficient sooner because of the supercharge that comes with the paid up additions rider.
If you'd like to get started with a specially designed whole life insurance policy, or you already have policies and you would like us to take a look at them, be sure to visit our website at tier1capital.com to schedule your free strategy session today. Also, if you like this video, check out these two. We picked them out special for you.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters. We'll see you in the next one.